From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go.
All right, everybody, welcome back to another episode of the Life Goal Playbook. Nick Rossetti here with Brett Sans. And today we're going to be tackling what might be the most talked about and probably most misunderstood headline-generating corner of the investment world right now, which is private credit. Brett, the last few weeks have been a really wild ride for this space. So I think today it's going to be important just to cover a few things. I think it's important to just highlight, and educate folks. What is private credit? How does it work? What role does it play in a portfolio? And what are some of these headlines, I think, getting wrong at this point in time? So what's been your kind of your take on what's being reported out there?
Absolutely, man. Heck yeah, this podcast hits extra hard today because it's St. Paddy's Day. So happy St. Paddy's, everybody. So I'll just start off with a little bit of why we think private credit's getting dragged into the headlines here when it's been essentially hiding out in the back for a couple decades now. A little bit of conspiracy theory here, but I think it's probably fair. The big banks. This used to be the big banks' lending business, right? Big banks lent to corporations across the United States. And then after 2008, government regulation forced the big banks to essentially reduce their lending to corporations and kind of focus on, higher quality lending and mortgages and things like that. And if we look at what's going on now, that you have, Trump coming in and looking to deregulate, the banks can potentially get back into this business, and because of that, they're looking to rattle the current players that are in the business. So it's that, in addition with hedge fund managers actively shorting the stocks of the big private market, private credit strategy, private credit managers that are out there like Blackstone, Apollo, KKR. There's a long list of them. So that is a little bit on the conspiracy side of it. Obviously, it's a big asset class that's grown a tremendous amount over the last several decades. So that's why they're in the headlines today, though. It's not because of the performance. The performance has so far been pretty darn solid. Most funds are up about 1% in the calendar year of 2026, with the S&P down about 2% over that S&P 500 equity market down about 2% over that exact timeline. So it's
and I think there was a couple catalysts leading up to this, which was the Tricolor situation, which was a private credit holding. There was a tremendous amount of fraud that went on there. So some of the concerns about maybe the credit quality because of the growth of the space was kind of an issue. But then really we've seen an acceleration here over the short term with the evolution of AI and the concerns that may have for some software names. So there was a little bit of momentum, a little bit of concern. I think, to your point, I think some folks are being a little opportunistic and trying to take advantage of a little bit of weakness there. But I think just going back to, for folks who are maybe a little less familiar with the asset class, let's just break down private credit for them, what it is. You kind of hit on a little bit there that it was banking activity and things that the big banks, JP Morgans of the world, were running point on, and that's kind of changed hands. But just give folks who may not be familiar a little bit more of a breakdown there.
Yeah, so the best way to think about private credit is actually to use another name that it's also called, which is direct lending. The direct lending name makes it a little easier to understand. So essentially what's going on is the lender, who in the modern world that we're in now, the investment landscape is essentially wealthy families and institutions. They're the lender. They're coming right up to the company, and they're lending directly to the company. Whereas historically, the bank has stood in between there, right? And the bank was the lender, and they were taking deposits from wealthy families and other folks and essentially turning it into loans. But when you come right up to the company, and generally speaking, it's a private equity company, right? It has a private equity backed sponsor, right? So a lot of these, unicorns that are out there like Databricks or Anthropic, any of those type of names, they may have that out there as well. That would be, if it was lent to, a wealthy family or an institution, that would be an example of direct lending, because the bank is not standing between them. And what that does, it takes out the middleman. It puts the yield directly into the pocket of the lender, and that can be as much as 3%. So that's essentially kind of what it is at a high level. The way it's been delivered to the wealth management world where we operate, essentially helping wealthy families and retirees, navigate whatever challenges they may be presenting, is in a pooled vehicle, much like a mutual fund, right? But oftentimes it will have a credit investor where you have to have $1 million worth of net worth, or you have to meet certain criteria in order to be able to go into the fund. And then the other unique aspect to these funds is they offer quarterly liquidity. Very different than a traditional mutual fund or an ETF where you can sell every single day, right? Quarterly liquidity. And the reason why is because this is not a liquid asset class. This is a illiquid asset class, right? It's not a public security like it used to be with a loan or a bond that the bank issued, right? It is a loan that is made from the lender to the borrower. And if somebody else is going to step in and buy that loan, they need to underwrite it, to understand what the risks are. So it's less liquid. Because it's less liquid, it needs to go into a less liquid vehicle. And that's actually where, some of the concerns are as well. So think about it as a quarterly liquid vehicle where you're in with many other investors, hundreds, thousands of other investors, multi-billion-dollar funds. And the benefit of the size of the fund is it allows you to get diversification across all the different sectors of the economy, right? So the loans, let's think about the loans. This is critically important. People talk about AI coming in and changing the software landscape, and that absolutely looks likely, right? But it's going to take, 5, 10, 12, 15 years to completely change the landscape of software. Well, guess what? These loans we're talking about are 3 to 5 year loans most of the time. So all that needs to happen is the company needs to be solvent 5 years from now in order for you to get paid whole on your loan, right? In order to make, get all of that money that you lent back, as well as the interest along the way. Two things that we should not confuse this with. This is not a 30-year mortgage, right? This is not a 30-year loan or a 20-year loan. This is a 3 to 5 year loan, right? And what people actually own may only have 1 or 2 years left on the loan, right? Because it was a loan that was issued a while ago, and 3 years later, the only part of it is left. What is it also not? It is not equity, right? This is not private equity. We do not need the company to appreciate in value to get our return. All we need is the company to remain solvent and be able to cover their debt. So who are the borrowers? The borrowers, and we brought this up a little bit, but just to add a little bit more context, generally speaking, it is very well-established countries throughout the United States and even the world for that matter that may do $100 million in revenue per year, EBITDA per year, even potentially way more than that. They may do billions in revenue per year. And oftentimes they're private equity sponsored. So private equity names are some of the names that we mentioned earlier, like Blackstone, KKR, Apollo, Carlyle, et cetera. Those are all publicly traded, very large, extremely well-respected private investment managers that have been around for decades, and they will help startups go from being, a startup, an idea in somebody's garage, to being the next SpaceX or the next, Anthropic, whatever it may be. Along the way, it's highly likely that they will raise private equity funding, which means the person giving the money owns a piece of the company. And it is also highly likely that they will need debt, right? They'll do debt financing, which means somebody does not own a piece of the company, but they are lending to the company. So that's kind of the setup.
Yeah, no, and I think that's good breakdown of what the asset class is and who these loans are and direct lending is going to, and I think a lot of folks will also comment just on the size of the market. We kind of teed up as to why these other private market participants have stepped in because of overregulation, but there's been a huge growth in this asset class because of the tremendous returns that it's provided over time. Not only just from a total return perspective, but from a risk adjusted, looking at the volatility of the asset class. And we've been in a yield starved environment, right? I mean, looking at, high quality fixed income, investment grade. Over the last decade, it's been extremely, extremely low. Net inflation, you're barely getting a real return. So there's been a lot of demand across the board for folks to go out and earn a little bit more income. So that's really been the another driving force in why the size of this market has grown as rapidly as it has.
When looking at the private credit asset class, it's incredibly important to understand the loan structure and also the corporate structure, if you're talking about a corporation in the United States. So when you're trying to wrap your head around the risk of private credit, right, it yields 10%, which is incredibly attractive, and that's why it's 10%, 10 or 11% is the yield right now, generally speaking. So it's incredibly important to understand. Okay, well that's my return. What is my risk? And you need to look at the corporate structure, right? So go back to your MBA textbooks and look at how if a corporation goes bankrupt, who gets paid out and when. That's really, really important, okay? So if we think about the corporate structure, at the top of the corporate structure, if something goes wrong, the very first person to get paid or a group of people to get paid are debt, right? So debt can be either bonds or loans, and they can be either secure. If it's senior secure, that is the very top of the stack. Just so happens that's exactly where private credit falls, the vast majority of it, right? About 90% of the private credit universe is senior secure, the stuff that most wealthy folks are investing in. And even, even some of it's higher than that. It's almost pushing 100% senior secured. Below senior secured, you have subordinate debt. Below that, you have preferred stock. Below that, you have common stock. So if the company, if the U.S. goes into a recession and the company essentially goes into a bankruptcy situation, the people who are going to get paid out with the remaining of the assets that are left at the company, the very first person to get paid out is going to be the people that are senior secured. That is exactly where private credit lands. So we are in the single best place you could be in the corporate capital structure. Guess where the vast majority of the founders of these firms' wealth is? It's in either preferred stock or common stock. That is below senior secured debt. So this is incredibly, incredibly important. This is the most important point to be made on this entire podcast. If the company's going to go bankrupt, the private credit lender is going to take out the equity ownership of the company. They are going to get the equity ownership of the company away from the founders. That's what happens. That's what the corporate structure means. That said, everybody knows, if anybody knows a founder, they will go out on their shield before they will give up their equity position, right? So they're going to do everything in their possible power to be able to pay off the debt that they have borrowed in order to retain their equity position. So that is so incredibly important to understand. These people you hear out on CNBC, obviously some of them know exactly what they're talking about, but a lot of the writers, beat writers that are on this topic have no idea or appreciation for this concept, and it is overlooked, and it cannot be overlooked. It is incredibly, incredibly important. And that's why if we do go into a default situation like we did in 2008 and in other scenarios where the economy is challenged at large, anybody who has senior secured debt, which again is what private equity is, or private credit is most of the time, generally speaking, they get paid out to almost 100 cents on the dollar. So you're in a very strong position at the top of the capital structure, and that cannot be left off of the top of this conversation. So Nick, going back to you we absolutely have several clients that are invested in private credit. We are personally invested in private credit, and I'd love to hear you kind of take us through how you see most of your clientele utilizing private credit or direct lending.
Yeah, no, I think it's got a role to play within a portfolio, and like all alternative asset classes or private markets, no matter what risk asset it is, actually publicly traded or privately, just sizing the allocation is really important, right? It's this isn't an asset class due to its illiquidity. The 10% returns have been fantastic over the last couple of years, but you're not going to put somebody 30, 40% of their money into a private credit strategy, right? So we typically size these between, depending on your objectives, time horizon, 5 to 8% of a model can be allocated there, deliberately measured, And we use different managers with kind of different focuses within that space. But you've got great income generation. Again, we hit on the yield between 9 and 10% versus the 4% you're getting on the 10-year Treasury right now. If you go into investment grade corporates, you might be getting 5%. The diversification benefits, which right now are being used to attack the asset class because of the liquidity and illiquidity features of this. But those have really provided a lot of stability to an overall portfolio into the asset class over time. And folks who are saying like this is the first time that private credit has ever been, and direct lending has ever been stress tested, just look at the situations that we've experienced just in the last 5 years alone. We've had COVID, 2022, we had massive inflationary spikes. And here we're heading into a new war in the Middle East, and we've got AI disruption. So there's been a lot of different market cycles that this asset class has performed through. So I think it's a great way when you're looking at an entire portfolio, again, to have another uncorrelated asset class that's going to provide you equity-like returns at these income levels. So, I think it's, again, important to make sure that you're sizing that position correctly, and that the intention is not that this is going to be your down payment for your house, right? If you need the money in a very short period of time, this isn't where you're going to throw all of it in.
Yeah, 100%. You hit the nail on the head there, and that's that. If you're going to go into this, into any asset class that has a quarterly liquid structure, you need to be thinking long term, right? And if there are situations where we may have an investor that has more than an 8% sleeve in this, and even up to 25 or 30% in things like this, but that is done in such a way that we understand the liquidity needs of the client, and the client has indicated to us that they want to, essentially target that income level, that 10% yield, and then we will marry that with daily liquid strategies. And we've actually done podcasts before where we talked about utilizing, private credit in addition with municipal bonds, investment grade municipal bonds, and you have a barbell there of a lot of yield and credit risk with the private credit. And then with municipal bonds, you have a fair amount of interest rate risk, but no credit risk, right? Because generally speaking, municipal bonds are, have extremely low default rates. But for those of you that are listening, you're not going to see this, but for anybody who would catch this on YouTube or any of the podcast channels, you actually see the video. So I'm just holding up a chart here of the returns of the direct lending or private credit index going all the way back to 2019, and I'll just read a couple quotes off here. So they're calling this the wall of worry. So here's a quote from Institutional Investor: If high yield is oxy, meaning Oxycontin, private credit is fentanyl, right? And that was in January of 2020. I'll give you another one here. This one is from the Wall Street Journal in June of 2020. Payment problems rise in the fast-growing private debt market. Here's one in 2023. UBS, this is a UBS employee, warns about bubbles forming in private credit. And then the last one here that I'll read, of about a dozen that are on this sheet of paper, is short sellers bet against private credit lenders. That's a Bloomberg quote, May of 2025. Okay, over that entire period of time, this asset class has returned approximately 10% per year and has had very, very few down months. Okay, and in 2025, it clocked in at like an 11 or 12% return, even though the Bloomberg quote came out in May of 2025 that short sellers were essentially, stepping up. And the Jamie Dimon and the cockroaches comment came out, that was October 14th of 2025. And the asset class performed strongly into the end of the quarter. And even so far in 2026 here, you've got a positive return of about 1% for the asset class. I do want to isolate, when we're talking about AI and software, that is a niche of a niche market, right? We're talking about a subsector within the technology sector, which is one of the 11 sectors of the S&P 500. And we're talking about direct lending in that sector. That is a sidebar conversation, right? Generally speaking, what we're talking about here, Nick and I, is a broad basket of direct lending or private credit. And that asset class, we think will continue to perform very well in 2026, and it performed very well last year in 2025, even though Jamie Dimon, who I think there's a conspiracy theory behind it, he's looking to get his lending business back, is beaten up on the asset class, performed very well there. And then I'll just say this too. Literally earlier this morning, Nick and I were on a call with the top 3 biggest active traditional bond manager out there, not a private credit direct lending manager, a traditional bond manager, and they told us verbatim that they anticipate this asset class, direct lending asset class, to do 7 to 9% return for the calendar year of 2026. Okay. That is not a bad return. Who's not, that's a pretty solid return from a debt-oriented asset class where you're senior secured, right? And that's somebody that is incentivized to speak poorly about the asset class because they have they don't have as many funds in the private credit space. They have more funds in the traditional bond space. So it just gives you some context there. Like, all this news coverage is blown way, way, way out of sorts. This asset class is in solid shape. Now, we can go kind of down and talk a little bit about, kind of what we saw in 2008 for the asset class. And then we could talk a little bit about, flows and gating and things along those lines. But, Nick, I want to toss it back to you on calendar year of 2008, right? Great financial crisis. And then what do we see there?
Yeah. So, again, we talked about kind of some of the short-term credit cycles that we've seen in the last 5 years, but this asset class has got a much longer track record than just that. You go back to 2008, the S&P 500 ended the year down 37%. Peak to trough, it was down 55%. High-yield bonds, publicly traded high-yield bonds, ended the year down 26%. Private credit realized losses peaked at 9%. So the income that you were generating off of those loans, off of that, it more than made up for the drawdown you experienced or the markdowns that were in the portfolio. So that's obviously been the greatest period of market volatility the world's ever seen. The whole entire world was brought to its knees in 2008, and this asset class really, really held up very well against traditional equities and fixed income. So I think that is worth mentioning when folks are screaming, running around saying that this is the next 2008. It's like we've already seen that. It actually wasn't quite that bad.
For sure. I think one thing that's important to bring up, and I've brought up a couple times this year, the performance so far for the calendar year of 2026, that this asset class is up about 1%, even though the S&P over that same time frame is down, about 1.5% to 2%. And people will say, well, hey, the valuations on those loans are not accurate, and I would counter that by saying that's a fair comment, and I think that some of the big private credit managers out there are probably not doing a great job marking their book accurately, but I do also think that there are several examples where we have had marks on loans that we do think are accurate. And then there's also a fair number of funds out there in the calendar year of 2026 that year to date are down 1.5%. Okay, if a private credit fund is down 1.5% for the calendar year of 2026, I would argue that it is being marked accurately, right? It's similar to the S&P 500, and it has a similar return profile to the S&P 500, about 10% per year. So, but keep in mind too, Jamie Dimon, this is important. Jamie Dimon talked about the cockroaches. When he was talking about that, when that news broke, was October 14th of 2025. I can tell you that any financial advisor that's worth their fee did a deep dive into their book of business the second that those words came out of Jamie Dimon's mouth. And that's exactly what we did at Life Goal. We went and we analyzed their book of business and our assets, right, that our clients hold and that we hold personally. We took a deeper dive into them, make sure that, we had a good understanding for what's going on. When that happens, that essentially is a stress test on the asset class. You had all these different active managers out there looking at their pricing, right? So that in its own right, does a little bit with flushing out any false valuations. And then I'll just give a couple other examples here. So Blue Owl, right, which was the original problem child on this a few weeks back, they sold $1.4 billion in private credit loans at 99.7 cents on the dollar. Okay, there was an actual transaction that happened in the market. So $1.4 billion sold for 99 cents on the dollar. Cliffwater, who is another very large private credit manager in the interval fund space, it's quarterly liquid strategy. They just did a sale 2 weeks ago, $1 billion sale. Okay, and if you look at the performance of that fund, it is still positive, and it really hasn't had much of a drag. So we don't know what the price of that sale was, but they did release an article that said they sold $1 billion worth of loans. So I can tell you that those loans did not sell at 70 cents on the dollar. If those loans sold at 70 cents on the dollar, there'd be a massive dip in the net asset value of their fund. The net asset value of their fund is essentially, a flat line right now. So that didn't, we could tell that the price is not terrible. So it just kind of goes to show that there are folks out there that we think, because you can see performance out there too, that may look a little bit inflated in the calendar year of 2026 on some of the private credit and direct lending strategies. And then you can see some that are down 1.5%. Goes to show that there's probably better marks in some places than others. But also, not everything is software, right? This is an asset class that has a fair amount of exposure to software, but I would argue that 80% of the asset class is not software, right? So there's a lot of differentiation there when you look across the underlying subsectors. So Nick, going back to you, when we were talking about the performance of private credit in 2008, I think one of the things that saved the asset class, that allowed for such strong performance, was the gating feature. So coming right up onto one of the topics we wanted to hit on is the redemptions that are seeing redemption spikes right now. So I'll toss it over to you for that.
Yeah, no, and that's one of the other big concerns that journalists and investors are bringing up. So it's important to kind of look at what's going on. So a lot of these funds, typically in an interval structure, will allow up to 5% of the fund's NAV to be redeemed per quarter. That's the kind of the typical average. Anything above that threshold typically gets held back, right? Gated is the term that they use. So if more than 5% is redeemed, you'll get a prorated amount of your redemption request back. This is a lot of folks out there are screaming that this is a negative, but largely when you're looking at this space, the liquidity profile of the fund matches the liquidity profile of the underlying securities, and that's really, really important. Those quarterly redemption gates are doing exactly what they're designed to do. This isn't a sign of failure. This is a mechanism working as designed. So if the manager was forced to sell, let's say 20% of his portfolio, he's going to be forced to sell illiquid assets and probably have to get rid of them at a really deep discount. And we've seen that on the public side as well. One of the fixed income managers I worked at many years ago now, but invested in a lot of securitized credit, just smaller pools of consumer-based loans, right? So these were, in this particular case, was AAA rated credit card backed loans from Citibank. They were senior secured. This was all during COVID. The only way that you wouldn't get paid back as the bondholder there is if Citibank went under and closed up shop. So this thing was money good, but we had big redemptions. It wasn't a quarterly liquid strategy. It was daily liquidity. Managers had to sell that bond at, call it, I think it was 78 cents on the dollar, because they had to meet those redemptions. So that's I think is the misunderstanding that a lot of folks who are talking about this loudly don't really understand that's actually a benefit to the investors that are in this fund, that you don't have these massive swings and are forced to sell good assets at the wrong time, right? So, and we've seen examples of that previously, right? I mean, if you go back and look at Blackstone, right, Brett?
Yeah, so two examples. One, I think that had everything to do with the success in the performance of the private credit asset class in 2008, was that it was in quarterly liquid hands, right? It was institutional investors, generally speaking. It wasn't in daily liquid hands where they were being forced to sell and essentially create fire sale pricing. But I'll give you another example. So Blackstone, as most folks know, one of the biggest private managers out there, John Gray, who is going to step in for Steve Schwartzman when he retires, most likely be CEO of the firm, gave a quote the other day on happened to be a really good example of where gating protected shareholders. So they run one of the biggest private real estate funds out there. It's called Blackstone BREIT, right? It's like a $50 billion strategy. And throughout the life of the strategy, which it has, I think, a 15-ish year track record, there were 3 quarters when clients could not get their money out because it was gated. They could get some of their money out, but not all the money. If they wanted to request 100% of their money back, they prorated it and gave them a fraction of it back. Again, that strategy, the liquidity profile and that 5% rule is the exact same what we're talking about right here with private credit as an asset class. So BREIT held funds back from clients for 3 quarters, okay? Throughout the life of that fund, which is approximately 15 years, it has outperformed the public real estate market that is daily liquid. You can get your money out of any time you want by 60%. So the question becomes, are you willing to trade off some liquidity for excess returns? And it doesn't mean that, just because it happened in BREIT that the same exact thing is going to play out in the private credit space. But guess what? So far, that is more than played out, right? Private credit has absolutely outperformed the public debt markets materially, right? And it forecast by most large institutional money managers to do it over the next 10 years too. It's forecast at about a 10% return because that's approximately what the yield is. So that is about double what you're anticipating from the public bond market. And yes, you're going to have to give up some liquidity if you want to be in there, right? It's quarterly liquidity and you shouldn't anticipate that you're going to pull it all out, right? You only want to go in if you're a long-term investor, right? Which is really important. And you need to have a very serious conversation with your financial professional about whether or not you are a long-term investor. If you're buying a house, you're probably not a long-term investor. If you're in a retirement pool with, your assets are going to be there for the next 30 years or 50 years, or even if they're going to be in there for 10 years in retirement, you're going to stream income off it. You can still stream the income. It's not like the income stops paying even though they gate the fund. So long story short is gating of BREIT, you had a 60% outperformance over the public market alternative. And the compromise was there was 3 quarters over that 15-year period where you couldn't pull 100% of your money out. And I think most people, if they were to step back and, ponder on that, they would be absolutely willing to make the trade-off. So, Nick, just kind of coming over here to kind of wrap things up, head towards the conclusion here. So 5 reasons why Life Goal remains constructive on private credit and direct lending. Again, this is an asset class that is extremely diversified, right? We are not talking about just software private credit, right? We're talking about an asset class that has every subsector that's in the, or every subsector and sector that's in the S&P 500. Generally speaking, you're looking at yields approximately 10%. Super attractive, right? We are senior in the capital structure of a company, okay? We are the top of the stack. That's what that means. If the company goes bankrupt, the founders have to give us their ownership, right? That's what that means. Yep. So the founders are going to give us their ownership that they broke their back to build, to pay us off if the company is going to go bankrupt. The borrower universe is broader than it's ever been before, and these companies are a lot bigger, right? Most of these companies are doing over $100 million a year in EBITDA, okay? Manager selection, okay? So we're not just going with any, this isn't an ETF that's a private credit manager. It's an actively managed strategy, right? We have fully vetted the active managers that we're using, and we have the highest level of conviction in these active managers. I'll say lastly, in addition to that, actually at Life Goal, we have put an emphasis on where we are involved in the direct lending and private credit space. We actually have put an emphasis on, and this was in place well before Jamie Dimon and the cockroaches comment came out, on hard asset-backed loans. So we want something with a piece of real estate behind it, or maybe an infrastructure project, or maybe an airline asset. There's a lot of airline assets in the space. And then lastly is when you have when you have a situation as we have right now, where there's a lot of volatility in an asset class, it actually creates a buying opportunity. And anytime that's the case, we want to consider coming in and increasing our exposure. It doesn't necessarily mean that we will day one, that we see volatility. And it also doesn't mean that we're going to immediately double our exposure. We may incrementally increase our exposure. But when there's volatility, if you're a value-oriented manager, which Life Goal we absolutely are, you have to step in there and take a deep dive into the space and see what you can find that you think is attractive. And then all that said, I'll also say that we will use multiple managers in the space to avoid the gating situation, or at least diversify the gating situation if potentially it does come up. And then also, you always want to have more than one active manager, because they're going to have a different angle on how they want to approach the asset class. One may see value in one sector where one doesn't. And generally speaking, that will help drive returns over time. So, Nick, just coming back to you on the 4 pillars that we see within private credit.
Yeah, and I think just with our approach, I think you hit on a bunch of those, but no matter what kind of risk asset you're looking at, it's important to size the position there appropriately and realistically for what your liquidity objectives are and what your tolerance for risk is, right? And then, you hit on the other ones, making sure you got the right managers. We want to see institutional grade underwriting, long-term track records across set credit cycles, and that aren't going to be levering up the portfolio to unacceptable risk levels, in our opinion. And then, those, with our process, we constantly have a constant due diligence process. We're monitoring these managers actively. We want to make sure we understand what's under the hood of the funds that we own, personally and for our clients. And then, just got to recognize, no matter what asset class you're looking at, but in regards to private credit, you just need to acknowledge what it is and what it isn't. It's a diversifying tool. It's an uncorrelated asset class that provides great levels of income that are very difficult to find anywhere else in the marketplace. But it's not really a replacement for equities. This is not a cash alternative, right? So again, just having the right mentality and an approach to that space, I think, helps us and our clients, broadly speaking. So with that, Brett, let's wrap it up. I think we've given a lot of good information for folks to think about, and maybe some context to battle some of these headlines that are floating around.
Absolutely. Happy St. Patrick's Day to all out there. And we do think the asset class continues to deserve a piece of the asset allocation, even after this news and potentially the redemption issues that the asset class may face. We see it as an institutional grade asset class that is around for the long haul. And we think that it's a great opportunity to maintain your position and potentially even look to increase your position size with the volatility that's in front of us here. So thank you all so much, and we look forward to catching up with you next week on another podcast.
Quick ask. If you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much.
The information discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.